Let us know more about the Central Bank of India. Central Bank of India is Reserve Bank of India, established on 1st April 1935 under the Act RBI Act 1934. It was recommended by the committee Hilton Young Commission and started with the initial capital of Rs 5 crore. Earlier it was headquartered at Calcutta and now it is headquartered at Mumbai. The bank was nationalized on 1st January 1949. The logo of RBI shows two features, that is the palm tree and the picture of tiger. Earlier it was lion. Later the government of India decided tiger as the more characteristic feature of India, and this it was enabled on the logo. Looking towards the structure of RBI, it consists of CBD and local board, which are constituted by the Transfer of Public Ownership Act and central government respectively. The Central Board of Directors conducts one meeting at least every quarter and at least 6 meetings every year. Moving ahead, let us see the structure of CBD. It consists of 21 members. There are non-official directors, which includes 10 directors that are nominated by Government of India from various fields, along with 2 government officials, one from the economics department and other from finance department. There is a director from local board, which is nominated by CBD and by the central government. The tenure is 4 years of the members. From the local boards, there are 5 members each from each regional office. Additionally, we have 3 executive directors. Local board office centers are located at metro cities like Mumbai, Calcutta, Chennai, and New Delhi. Offices of RBI are 31 in number, that is 27 regional offices and 4 sub-offices. Coming to the official directors, we have 1 governor and 4 deputy governors. The tenure of each is 5 years. The very first government appointed of RBI was Sir Osborne Smith. The picture of CBD member structure is here, which shows 10 nominated directors, 4 deputy governors, 2 finance ministry representatives. It consists of economics plus finance representative, 4 directors and 1 governor. The total number stands here is 21. Moving ahead, we'll know fully owned subsidiaries of RBI, that is DICGC, Deposit Insurance and Credit Guarantee Corporation of India, Bharatiya Reserve Banknote Mudra Private Limited BRNB and PL, Reserve Bank Information Technology Private Limited, that is REBIT, Indian Financial Technology and Allied Services IFTS. RBI has its own training centers. There are 6 training establishments. The first 3 are RBI Academy, College of Agricultural Banking and RBI Staff College. Further 3 independent autonomous institutions are National Institute for Banking Management, Indira Gandhi Institute for Development Research, that is IGIDR, and Institute for Development and Research in Banking Technology, IDRBT. This is the picture which shows the regional offices of RBI at different places. Now, talking about the history of RBI, RBI acted as the Central Bank of Myanmar or Burma before April 1947, that is before independence until April 1947, and after independence, that is partition of India, the bank served as Central Bank of Pakistan till SBP, that is State Bank of Pakistan, started in operation in June 1948. Initially, RBI was set up as a private bank with private shareholding, but after that, RBI became fully government-owned bank after nationalization 1949. It was nationalized by the government through an act called Transfer of Public Ownership Act 1948. RBI has a monopoly of note issue except 1 rupee notes which are issued by the Ministry of Finance. The RBI is permitted to print currency up to 10,000 rupee notes. Minting of coins is solely done by the Government of India. It is not done by RBI. but the coins are issued for circulation only through the RBI terms as per the RBI Act. The responsibility for coinage rests with the Government of India in terms with the Coinage Act 1906, which is amended from time to time. The designing and minting of coins in various denominations is also the responsibility of Government of India. Coins are minted at 4 offices, that is Mumbai, Alipore, which is in Calcutta, Hyderabad and Noida. Besides being named as bank, it does not fall in the category of commercial banks, and it does not do the banking functions like the commercial banks do under the Banking and Regulation Act 1949, that is, accepting deposits and lending money. Apart from it, RBI controls the changes in stock market. It controls the changes that exert a powerful influence on prices. It greatly influences output and distribution of income and wealth, which ultimately affects the employment of our economy. It helps in balancing income and wealth distribution, ensures price stability, balanced credit expansion, and long-term investments in an economy. RBI is also a member of ACU, that is Asian Clearing Union, which was the initiative of United Nations Economic and Social Commission for Asia and the Pacific, ESCAP. The primary objective to establish it was to secure regional cooperation of the member nations and to enable the monetary transactions among the members of ACU and provide them a system for clearing payments on a multilateral basis. The bank is also active in promoting financial inclusion policy and is a leading member of the AFI, that is Alliance for Financial Inclusion. So the bank is often referred by the name Mint Street. RBI also acts as a custodian to foreign exchange and detection of fake currency. RBI has the custody of the country's reserves of international currency, which enables RBI to deal with the crisis connected with adverse balance of payments position, and it also keeps check on the originality of the currency to avoid the circulation of fake money in the market. Now, there are various methods resorted by RBI to achieve its objectives. Let us look one by one. First is open market operations. Second is bank rate mechanism. Third is maintaining different rates like SLR and CRR. Next is MSF, that is marginal standing facility and liquidity adjustment facility. Exchange control mechanism, credit rationing, model suasion. There are different interest rates like repo rate and reverse repo rates. Then asset management norms. Looking in detail one by one, we'll see first the credit control measures, which are divided into two: quantitative. In quantitative, we have bank rate, cash reserve ratio, open market operations, interest rates, marginal standing facility, liquidity standing facility, statutory liquidity ratio. And then qualitative credit control measures, we have model suasion, selective credit control, credit rationing and reporting, and direct action and licensing. Let us look in detail. Open market operations refers to the central bank purchases or sales of government securities in order to expand or contract money in the banking system and influence rates. So, in open market operations, the central bank purchases government securities so that there is flow of money in the market. When the government purchases something, it provides money in the market. And when the government sells government securities in the market, it takes money from the market away. And so the money contracts in the banking system and thus the interest rates are influenced. Next is cash reserve ratio. It is the proportion of funds banks have to deposit with RBI. Any change in CRR percentage means either increased availability of funds with the banks or reduced funds available in the market. Unchanged CRR means no additional funds available for banks to lend. It is a very important aspect in the banking system. Moving ahead, we have SLR, Statutory liquidity ratio means a portion of deposit liabilities banks are required to maintain with RBI in the form of liquid assets so that when the banks run out of liquidity, they have SLR to safeguard them. As and when RBI increases the SLR, it reduces fund supply in the market. This by reducing the lendable resources with commercial banks. Vice versa, when SLR is reduced, it will increase the funds with banks for onward lending. Moving ahead, we have bank rate. Bank rate means the rate of interest at which RBI buys or rediscounts bills of exchange. As per the end of the hour, RBI raises the bank rate in order to squeeze the credit expansion. So when the rate is increased, the credit expansion contracts, whereas it reduces the bank rate when it needs to allow more flow of credit in the economy. The last is interest rates. Interest rates consist of repo rate and reverse repo rate. Repo rate is the rate at which banks borrow from the RBI, and reverse repo rate means the rate at which RBI borrows from the bank. So, in the repo rate, the bank's borrowing cost will go down, which could prompt banks to cut lending rates. This is how the different rates influence the working and the flow of credit in an economy. Then comes credit rationing. Credit rationing is nothing but it is a type of ceiling fixed by the RBI for specific categories of loans and advances to control and regulate the purpose for which the credit is granted by the commercial banks. The ceiling is also of two types. First is variable portfolio ceiling and second is variable capital asset ratio. The central bank fixes a ceiling on the amount of loans and advances for each bank and the bank cannot advance loans beyond this limit. Moving ahead, variable capital asset ratio. It is the ratio in which the central bank fixes in relation to the capital of the bank to its assets. That is, variable capital asset ratio is the ratio between the capital of the bank to its total assets, whereas in variable portfolio ceiling, the ceiling is on the amount of loans and advances for each bank, and beyond that the bank can't have advanced loans. So that is the limit fixed by the RBI. Next is moral suasion. Moral suasion is a qualitative method of credit control used by central bank to use its moral influence on the commercial banks. It influences commercial banks morally by using its advices, suggestions, requests. It persuades the commercial banks to operate with the central bank so that at any time if the commercial banks do not follow or they have any sort of issue, the RBI as a measure of controlling commercial banks uses the policy of moral suasion. Next is MSF. Now MSF is a window for the banks to borrow from RBI in an emergency situation where interbank liquidity dries up completely. When I can't borrow internally from other banks or other financial institutions, I have the last lender of last resort, that is RBI, to borrow from. Under MSF, that is marginal standing facility, banks can borrow funds up to 1% of their net demand and time liabilities. A liquidity adjustment facility is a tool used in monetary policy mainly by RBI. It is used by RBI to enable banks to borrow money through repurchase agreements or banks to lend to the RBI using reverse repo rate. So either bank can borrow money using repurchase agreements from RBI or banks can lend money to the RBI using reverse repo rate. So this is the recent policy rates of different types of bank rates, interest rates decided by RBI. RBI is the one who decides different types of rates. So do let me know in the comment box who decides the saving deposit rates in India. Looking ahead, we have functions of RBI. So the very first function of RBI is licensing of banks and branch licensing. RBI provides the license to the banks and thus license them for their branches so that it avoids the circulation of fake money as well opening of the original institutions and not the fake ones. Moving ahead, we have RBI, who acts as a lender of the last resort. In any case of emergency, RBI provides financial help. It means meeting the genuine financial requirements of commercial banks in case of emergency. Regulator and supervisor of the bank's payment and settlement system. RBI is the sole authority who advances loans to the public, and it is the regulator and supervisor of the banks as it licenses banks. It provides license to their branches as well. So, and it regulates different types of payment system. Like recently, RBI decided to have no charges for RTGS and NEFT payments. It removed the charges which they used to charge to conduct those payments. So RBI regulates the payment and settlement system, and it plays a pivotal role in building up the economy's financial structure, as everything happening in the finance market is supervised by RBI. It serves as a banker to the government. Now, whenever the government has any problem, RBI is the one who acts as a guide and controller of banking and financial sector. Thus, it helps the banks to ensure proper governance and sound banking practices as well. So, it acts as a banker to the government. It manages forex department, that is foreign exchange, their currency flow. Moving ahead, it acts as a banker to the commercial banks, as I said earlier. It ensures proper governance and sound banking practices. So, this were the few functions of RBI. Looking ahead, it acts as the currency authority. It is solely responsible under Section 22 for the issuance of currency notes, excluding 1 rupee note, which is issued by the Finance Secretary of the Government of India. It regulates the issuance of the notes in India mainly to bring confidence among people of genuineness, quality, and credibility of money issued, besides bringing in uniformity in issuance of notes. Due to single authority, there is effective control on flow of credit in and out of the market. Next is controls money supply and credit. So it controls money supply and credit using different types of bank rates. It has quantitative and qualitative credit control measures discussed earlier. It is the advisory body as it provides advices to the government, to the commercial banks, and to the different types of financial institutions in conducting banking and financial operations, and on various different economic issues as well. So it is the major advisory body in finance department. Financial accommodation to cooperative banking sector. It provides financial accommodation to cooperative banking sector for financing special sectors of the economy like agriculture, MSMEs, etc. Financial supervision and ensures sound banking practices. Next, it promotes specialized institutions. As a developmental function, RBI promotes various specialized institutions, like it has promoted EDB, NABARD, SIDBI. Then we have DICG, TSME, and ECGC, Export Credit Guarantee Corporation of India. Last is Public Debt Office. It acts as a CDS for G6 securities. In the Public Debt Office function, here the management of raising of finance by the government and issuance of new loans and advances on behalf of the government of India or state government is handled by the Public Debt Office of the RBI. So RBI acts as CDS, that is Central Depository Security for government purchase or sale of government securities. So here I have few questions for you. Do comment in the comment section if you know the answers. In the open market operations, dash of securities means the flow of money contracts and dash of securities means the flow of money expands. The answer would be either purchase or sell in the two lags. Next is dash is the interest rate used by the RBI to absorb liquidity. And the last question is who decides the savings deposit rate in India? Stay tuned for more such videos.